forexbrokers.net, and we move on with a new video, part of our Trading Academy, dealing with basic technical analysis patterns. This time the double and triple tops and the head and shoulders pattern. Before starting, keep in mind that the two patterns belong to classic technical analysis coming from the United States, from the earliest start of stock market trading. And the double and triple top, the double bottom and the top, as well as the head and shoulders, they are reversal pattern, meaning in order for them to form, you need to have either a bearish trend like we have here or a bullish trend like there is here in order for the reversal pattern to take place. A double top or a double bottom always forms against a horizontal base. However, because of the high volatility on the FX market, this is more an area than a precise level. Also, there are differences in prices shown by different brokers that use different server time. For instance, the closing on a 4 hours candlestick or a daily candlestick differs depending on the time zone where the server is placed. Therefore, look for a bit of flexibility when interpreting this kind of patterns. Anyways, everything that we will discuss here belongs to the article that's already written in the Trading Academy. Here only I want to make it a bit visible what the patterns are. So for a double bottom, this is a bullish reversal pattern that resembles a W, the W letter. The market comes to a level, fails to make a new low. This is a neckline of the pattern, and always when you trade the financial markets, you try to use a risk-reward ratio that makes sense, meaning that normally minimum a 1 to 2 risk-reward ratio would help you grow steadily the trading account. This will be the risk, and this will be the reward, 2 times the risk. Moving forward, here there is a bullish trend, and then we see that the Great and Pound US dollar on the daily chart failed at the 1.43 one time, 1.43 for the second time, went back to the neckline, broke lower, and at this point in time this is the measure move or the risk, 2 times the reward, and then the currency pair, the market reaching the risk reward ratio. Conservative traders would leave no room for chances, and a standard approach is that by the time that the market reaches 1-to-1 risk reward ratio, so if this is the risk, this is the entry, this is the risk, and then by the time that the market reaches 1-1, conservative traders move the stop loss to break even and book half of the profits. Now, this is the reason for doing that is, first of all, to protect the profits, and second of all, by booking half of the profits, a margin or the blocked margin, the collateral that the broker requires for keeping the position open, becomes free margin available for a new trade. I mean, there are so many currency pairs, so many time frames, so many patterns that instead of waiting for a 1 to 2 risk reward ratio, just book half, put the stop loss at break even, so nothing wrong can happen anymore. It's a free trade, and then you focus the mind and the resources to other trades. Obviously, if the double bottom resembles the letter W, the double top resembles the letter M. The other pattern, part of this lesson, is the head and shoulders pattern. In this case, this is an inversed head and shoulders pattern because it forms at the end of a bearish trend. It has the following element: the left shoulder, which is a consolidation, the head followed by a quick retracement, another consolidation ideally similar with the one on the left side, and then if you connect the bases of the two consolidations, they show how price builds energy, and then it breaks higher. Trading the risk reward, trading the head and shoulders pattern is tricky. Many traders buy a break on of the neckline, which is okay, but it doesn't offer a positive risk-reward ratio. The ideal thing is to draw the neckline, as we explained in the article, copy and project it from the lower part of the left shoulder, and that would be the entry on the long side with the stop loss at the bottom of the lowest point in the head. So this is the risk, remember, risk reward ratio. This is the risk and this is the reward. Why 1 to 3? Because by waiting for price to come into our entry level, we gain one more we gain one more unit on our reward, and we don't want to go with to keep the trade open more than the measured move, even though this is a reversal pattern. So again, by the time that the market reaches 1-1, move the stop loss to break even, book half of the profits, stay for the reward, and use the released margin for other trades. So this is an inverse head and shoulder, but the opposite pattern is called head and shoulders, forming at the top of bullish trends. This is the US dollar and Canadian dollar, and the move higher coincided with the price of oil dropping below the $30 mark after from the 100 mark. Because the Canadian dollar is directly correlated with the oil price, and because the Canadian economy is energy intensive, the move lower in the oil price created an almost vertical move higher on the US dollar and Canadian dollar. However, on the move to the upside, we've seen a small consolidation, an aggressive move higher followed by a quick retracement into the same area, another consolidation on the right shoulder, and all this time, and this is the daily chart, all these days, 14 trading days, so it's no excuse that you can miss this kind of a pattern. So all these days, the market screamed that it formed the head and shoulders pattern, a bearish one, and then simply do the same thing. Draw the neckline. We already know the neckline from here. Project it, copy and project it from the highest point, from the highest point of the left shoulder. This would be the entry price. And then going short here, risk at the top. 1 to 2 risk reward ratio goes all the way to here. By the time that it reaches 1-1, because we are in the measure move, book half of the profits, move the stop loss and break even, and this is how you trade the head and shoulders pattern. Thank you for being here. Bye bye.